so much for being here. Today we have an interesting panel discussion on risk and opportunities in FX and commodities for 2023. We'll hear from leading experts on what potentially lies ahead as the doors begin to close in 2022 and we step into 2023. This year has so far been a tumultuous one. Gold steamrolling lower since March of 2022, recently crunching below daily support. Oil now comfortable below $100 per barrel. Against the US dollar, the euro is now down 15%. Sterling, as of Friday's close, down 20%. And the Aussie dollar down by 10%. And unless you've been hibernating, last week's marathon week of rate hikes from major central banks was a key market theme. This included the Fed and the BOE hiking their interest rates by 75 basis points and 50 basis points, respectively, as well as Japanese authorities intervening to prop up the value of the Japanese yen. As you can see, there's much to discuss. By way of a brief introduction, my name's Aaron Hill, and I'm the market analyst with FP Markets. We have a booth located at C9. Feel free to drop by and say hello to our very friendly team. So once again, thank you all so much for being here today. Given our panelists' varied skill sets and experience, this will serve as a lively and motivating discussion. So first on the chair is Gary. Gary is a proprietary trader in Forex and futures derivatives. And he's also the founder of Trader Quark and has been an instructor since 2015. He also has an extensive background with an impressive array of qualifications. John Murillo is the chief dealing officer at B2B Broker. And with more than 20 years experience in the industry, John has held several senior positions at many financial institutions worldwide. Next we have is Alex Katasaros, and he's the group CEO of Top FX, has been for nearly a decade, and is leading the firm's institutional and retail arms. Alex is a former head of product development for the team at C Trader. And last, but certainly not least, we have Lalit Matta. He's the CEO of Ya Markets and has more than a decade of experience in Forex account management, with expertise including analysis in macroeconomics, asset allocation, and investments. Okay, so let's move on with the key theme of the day: risk and opportunities of FX and commodities in 2023. Gentlemen, please feel free to pose questions to each other in order to help create a free-flowing discussion. And ladies and gentlemen, at the end, if there's time, we'll open the stage to audience questions, if any arise, of course. So without further ado, let's begin the proceedings in the oil market. Now, we reached $129 for WTI and $138 for Brent in March of 2022. I'm sure we can all remember that. And we have largely been lower since. So, gentlemen, where do we see the price of oil headed in 2023, and really what risks do you see investors facing? So if I can begin with Gary, please.
Hi, everyone. So regarding oil, this year we've seen the markets moving up and down in an uncorrelated way to generally to what we would have expected to be correlation with the oil, which is the dollar. The thing is, oil prospects is likely to be, if I could talk correlation, but it's not. It's going to be linked to the global geopolitical situation we are facing at the moment, and without seeing any progress in the resolution of the crisis, I don't see why oil will continue moving in an organized manner. So the oil up and down has been vivid this year. The thing is, if I look at it from a pure technical point of view, which is my area of expertise, I'm noticing now that oil has reached very strong level of resistance and is likely to fall. There are reasons for that. But first, let me tell you, it's going to fall in 2023. Probably first level is to $55. The bank's liquidity that have actually pushed the market up from the $0 level, if you remember, are at the level of $44, $55, and there's another area at $18, $32. So all that liquidity sitting in there has to be mitigated. The market is likely to go down to this level. Now, obviously, you need something to push the market towards this direction. Because Russia is not going to calm down, if I would say, on its threats to the world, I think people are getting more and more used to it. So they are less and less threatened by the idea that they have to hedge the risk with oil. So to me, oil is going to be pretty much on the side effect that it has to go down, simply because there are going to be other factors we're going to discuss, like the dollar, which is also going to probably go down even more, which is going to impact on the price of oil. So that's my analysis. So I think oil will go down to a 55.
Thank you, Gary. Cheers. So, John, please.
Well, thank you for the input. To some degree, I shared a great deal of your feedback. My expectation, and let's take into account the element of the geopolitical event between Russia, let's put it in mild terms, at the moment, that situation can have a significant impact as it did before. Now, the market has priced that in, and therefore we're seeing a bit of a correction, but we must keep in mind that for as long as this conflict continues, any disruption in supply can trigger another spike to the upside. On the flip side of that, we must keep in mind that we may be facing a recession in the nearest future, which essentially can trigger a downside momentum. So we have three elements that I see here. A, the geopolitical event. B, the possibility of a recession, combined with what I would call a retracement. If combined, I think 2023, we might see prices to the downside, primarily due to recession. Now, one can argue, the US is probably in a better position to withstand a recession than Europe, even than the UK. But it all comes down to how things will play out on a geopolitical level. I think that's the real key to dictate that price direction.
Thank you, John. Alex, please.
So let's talk about oil. For me, when analyzing a market or an asset, I obviously have to work with the information that I have at the moment. I have to agree that obviously any geopolitical changes are going to affect oil very much, and that's a given. We know that. I mean, it's always like that, and it's always going to be like that. But I cannot predict what's going to happen in the world. So with the information that I have, when it comes to oil, we have a situation where oil, first of all, it's a commodity. It means that its price mostly affected by supply and demand. When we had the COVID years, we had a reduction in supply. And when you reduce supply in oil, the thing is that it doesn't come back easily. When you stop extracting oil from earth, you don't just flip a switch and then you turn it back on and it starts coming up again. It's to bring it back to pre-COVID levels, the supply, it's like a process. And as long as this process is still ongoing, the supply is increasing. And when the supply reaches full potential, the prices are going to drop again. Now we're seeing that it's constantly reaching its full potential. Now, most of the countries don't have any COVID problems, supply is going up, so oil is going down. And it's going to keep, supply is going to keep coming up. So one factor is that the supply is increasing, that brings the price down. That's one of the reasons it's at $80 now. The second reason is that the dollar is strengthening. Even when we see oil USD, it's also a pair. It's like oil versus dollar. When the dollar is strengthening because of interest rates around the world, like versus everything, obviously it means that $1 is going to buy more oil. But then we have inflation at the same time. The inflation is like This is the biggest contributing factor to the price of oil for me, that the whole world is fighting inflation now. When the number one problem in the world, Europe and the US, is inflation, what is the most, what do you fight when you want to fight inflation? You fight the basic needs, CPI and whatever, and then you fight energy. You fight natural gas and oil. So the whole world is fighting to bring oil down. I mean, it's not going to resist. You cannot go versus the whole world. And that's why it's going to drop. And as long as we're going to have the same kind of inflation situation, everybody, I mean, all the governments are going to be trying to bring oil price down. It's to our best advantage, everybody. It's in our advantage now. So for that reason, I have to agree that obviously we're not going to see a rally in oil unless there is some sort of geopolitical tension that reduces supply very much, which is unpredictable, so I cannot predict that. Unless there is that, oil is going to stay at current levels, or we're going to manage to bring the price down even further in order to reduce inflation and, as an effect of the constant decrease in supply after COVID. So that's my answer. I hope it makes sense.
Yeah, something very interesting you mentioned is the correlation between the dollar and oil. Normally, we tend to learn that when oil goes up, it could be because the dollar is going down, and invertedly. The problem here is it's not working. The dollar is likely to go down for the 2023 prospect, and oil is still going to go down. The reason is what you mentioned, is the demand. The demand is not going to be as strong as before. Less demand for energy is going to have an impact on the big cap companies who can less likely export. If they can less likely export, they're going to earn less. If they earn less, it's going to have a huge impact on the S&P 500 crashing. And obviously, as you know, the S&P 500 also has its strong correlation to the dollar. That is why the dollar is down and oil is down as well.
It's not like I disagree with that. As I mentioned, I pinpointed 3 contributing factors. All of them are contributing. Oil being a commodity, the most important factor is always going to be supply and demand. Always. You cannot be supply and demand. If you have very high demand, low supply, it's going to skyrocket no matter what everybody's doing. That's obvious. But also, the weights of these contributing factors, it's not possible for me to know now. I mean, the dollar actually, the strength of the dollar is the least important contributing factor to the ones that I mentioned. So the most contributing factor is supply and demand. Second most contributing factor is a battle against inflation, because that will make governments think of 100 different ways to reduce the price of oil that we will not think here in this panel. And the last one is the strength of the dollar, but it has to be mentioned. So it's not like I don't agree. Sure.
Lalit, please.
Hi. If we talk about oil, I mean, what I believe, the oil is like more into fundamental, I think. It is more into demands. And if we talk about the demands, the major importer, I mean, if you talk about India and China, they are major import of the oil. And if you see, I mean, from the last couple of months, I mean, the China has been locked down. There's no import of oils and all. And there's much less supply in in China. And there's another factor, I mean, the US has aggressively recovering, but they are more focused into inflation. So there are many major movements, a fundamental factor, which is, the oil is falling. But I believe that the oil is going to reverse back soon. As, the first thing that China is going to open, the oil cities coming up, the more demand coming up. And even when we see the production is high, the supply is, the pricing is starting the lower. So now I can see that even the production is going to cut down. I believe, I mean, the price was, the rise around 113, 114 after the pandemic coming. Because the oil production was, almost a cut down. But when the pandemic over, everybody started the high production, So the price was different, I mean. So what I believe now is demand again, the markets has again demanding, and oil is always in demand. And I believe as per the technical view, I think the market not go to below even the 70 price, I can see the crude oil. And we can see in 2023, the price should be around 90, 95 the barrel. I believe this is what analysis in the market behavior.
Thank you, Lily.
Just to to complete what you just said, I don't obviously share your point of view because I was thinking that oil will go down, but I will explain why this dynamic is going to happen. We all share the idea that it was because of a sluggishness in the demand, in the world growth demand. If you look at the change of oil price since the 1st of January 2022, and you look at the same for copper, you will notice they are exactly the same. When you both see those two commodities going down at the same time, it is due to a lack of demand. So it's not because of some other factors. It's because the world demand is slowing.
I believe when
if
the
oil
price
price
is low,
at the level where it is today, it's too expensive. People cannot afford. What they will do is they will
but
simply
the pricing
stop
is low
consuming.
now. I think when the pricing is low in oil, the countries, even they import more. They store the oil. I mean, when the pricing is low, so I think this is the best price which I can see the China and the India they can import. I mean, if you go to the analysis into India and China, they are much more importing the oil. I mean, the pricing is very high. It's as per me. I mean, the pricing is good into the position where they can import and store the oil in. So I believe. I mean, it's like the market is the pricing. It is a fair price for the countries to import the oil and all, to store the oil when the oil is always in demand in every country. So we can see the reversal soon, but not as 100 and 200, 100, 100, even 100 above. I see the fair price will come up around 70. It will start reverse, and it goes around 90, 92, 93.5. I mean, it is somewhere, I believe.
Thank you, gentlemen. Now, gold is another commodity many are discussing, given its clear downtrend. Now, investors, I'm sure you may agree, generally use gold to offset losses against inflation. But the central bank interest rate hikes and the strength of the dollar, which recently hit a 20-month high, according to the dollar index, I think it's fair to say that the yellow metal is currently facing some serious headwinds. So what are your thoughts on the precious metal as we head into 2023? Do you feel that the dollar strength, increasing real yields, will continue to affect the metal? So I'll start with John, please.
Thank you for the question. It's quite interesting. I would say that in this particular asset class, commonly used by different types of institutions to hedge risk or offset some of that inflation pressure, the strengthening of the dollar has changed the dynamic in recent times, I would say. And that's primarily the driver, and that down pressure on gold is here to stay. The Fed is going to continue to hike. I think we'll have to agree on that.
I think we all agree on that, yeah.
It's inevitable. Inflation needs to be under control. It is not in any central bank interest to have inflation running at this level, and it's not in the best interest of society. I mean, if you look around, just the cost of living, no matter where you, of course, Dubai is an exceptional place, but in the general context, no matter where you are in the world, we travel quite frequently, and I see expenses whether it's in Asia, in America, inflation is taking a bite of everyone. So there is a coordinated interest globally by central banks to contain that. And that's where I see interest rates going higher, which means it's putting a lot of pressure on the metal for the time being. Going into next year, I think we're going to see somewhere around the 1600 area. That's just my own prediction, of course.
Okay.
A lot of dynamics, and don't forget, once again, I bring back the geopolitical aspect of things and the recent escalation between Asian countries and the Americans. Once again.
Please, Gary.
No problem. No, I like his analysis. I just want to say it from a different perspective. Gold is a risk commodity. It's a safe haven commodity, as you all know. But gold has been acting weird in the times of uncertainty to the world. As you could see this year, gold has been going down, but there are problems arising everywhere, geopolitically, economically speaking. So the thing here is now we are having this discussion about all the currencies and all the other commodities, but without talking about the other currencies too much, everything is going to fall this year. Oil, to me, is going to fall because of the lack of demand and the slow in the economic growth. Copper, the yen. We will have a discussion about the yen, the pound. I'm sorry, dollar is going to go down. So if investors are looking and bonds, there is going to be a huge bond crash happening anytime soon. So for an investor point of view, when people think, where am I going to put my money? They think either putting it long-term bonds, yeah, but it's not going to yield them a lot, or in a commodity that is already undervalued, probably due to the global economical aspect, and they think platinum, palladium, silver, gold at the moment. So I think there's going to be a rebound on gold anytime soon. In the coming 2 weeks, we are already at a level of liquidity grab, which is an institutional level, where banks are going to basically book their profits where all the stop losses of people, all the stop losses have been. So once the stop loss have been hit, there's going to be a correction up from 1625, which is about to reach in the next couple of weeks, to 1810, 1810. From that point, after, it could likely go back down once again before eventually the start of the crisis showcase, banks start liquidating the positions big time. Some banks may be starting to close the doors, and from that point, people will start buying gold. From that move for a move forward up to the 2000s, even breaking it. So for me now, it's about a rebound to 1810, and after that, maybe a correction down again.
Thank you, Gary. Please, Lalit.
See, gold is another, gold is like a safer investment. I mean, the people are more into the gold is like an investment purpose, which I believe. And gold is always correlated with the gold. Gold is always with the dollars, And from last few months, we have seen how the dollar reversal, how they are focusing on the interest rate hikes, and even they're more focused into inflation. And the gold has actually impacted. As I said, always it's a correlation between the gold and the dollar, which is a safer investment for the investors, which is going to be a safe investment and the better growth. And the current scenario we have seen, that's how the US is coming up with to impress the investor, to manage the inflation. And I think until next 2024, the US is not going to cut rates now. And it is going to impact it into the gold. If you go to longer the scenario, you will see the gold will have a very good fall around until go to 1400 even. So longer view, if you go, the gold is clearly fall. You can see the small rebound, reversal and all, but overall, the gold is I believe it goes to 1400 as per my views.
Thank you, Lalit.
I'm a bit worried because gold is not behaving as it should. And it's the last time it behaved as it should was back in 2020, 2019, when the COVID situation happened. Then definitely gold rose to the levels that it should, because it's like a safe haven asset that its price is supposed to rise when we have economic turbulence. But the thing is that now gold is not, we have a lot of turbulence in the markets, and also gold is supposed to be protection against inflation and everything else, and it's supposed to be a safe haven asset, but it's not behaving like that. It's just dropping. My fear, I don't care, but fear for gold is that it has become a little bit outdated, and there is something that has replaced the role of gold. In my opinion, I have to see the numbers more, get into the numbers more, but I think it's probably cryptocurrencies, especially in the retail world. So now where retail investors have fear and want to protect themselves against inflation or against anything else, they move to crypto instead of gold. And that's why gold is not behaving as it used to behave, and everybody was just buying gold when things got rough. Now they probably buy crypto, and maybe they probably do other kind of more modern investments. So that's my fear. And obviously, gold price is not going to be moved mostly by retail. It's going to move by governments and whatever. Maybe governments do that as well. I mean, we saw that we had countries that had hyperinflation and things were going very rough. I didn't see them turning to gold. They turned into crypto. That's what I think. I think that gold has become a little bit outdated, and I think we're going to have to reevaluate gold from the ground up and see its role in the world, because we cannot just continue judging it with the same rules that it used to be, like the safe haven asset, battle against inflation, all that stuff. We have to reevaluate it in the modern world now with crypto and everything else. Thank you,
Alex. Karen?
Yeah, you're opening a very, very interesting discussion here. I don't know if we will have time, but just to mention, you said crypto is probably the safe haven for the people who are looking for a place to invest in those turmoil times. But crypto has been tanking all year long, and where I see it, it's going to carry on going down big time. So if that is your safe haven, that means people are draining their money at the moment in every possible way, on their risk side and on their hedging safe side. So where do you see the crypto market going then, if you believe that this is the safe?
Yeah, John, please.
I'd like to take that question. We are, BitBroker is probably one of the largest crypto CFD providers and spot liquidity guys in the industry. And for that reason, we've been in the business for many years. So we have a very good understanding of this industry. And given the flow that we get from our client base, it is clearly, and I would like to elaborate on what you said before. It's very interesting that at recent times, there's a very strong correlation between gold and cryptocurrencies. Whether price action or not, that's a separate element on its own. It's about diversification. People want different asset classes where they can diversify themselves. And I think that's part of that crypto adoption we've seen in the recent times. Of course, we've had a correction. I mean, price went all the way.
Are we talking major cryptos here? Bitcoin?
Primarily, yes. Because we can, I personally call it the major cryptos, okay, because that comes from the FX world. Of course, there's all types of different tokens and that other stuff that is slightly different. But when we focus on the majors, and when I say majors, we're talking about BTC, ETH, XRP. We have a lot of clients positioning themselves on Ripple. That's primarily for Japan, geographically speaking. But in the general context, there is a tremendous involvement globally on BTC and ETH. I think those are the safe havens that many investors, and it used to be a retail aspect, but we've seen a lot of inflow of institutional money into the space. So back to the actual question, I think crypto, despite recent correction, it is being used as an additional hedge, as an additional tool to diversify portfolios.
Thank you, Gary. And Alex, do you have anything to add?
So the question actually is like, if crypto is a haven asset for retail investors, why isn't crypto price rising when things are going wrong? Well, my answer is that even though it was inferred, I did not say that I believe cryptos are mostly, their role is being a safe haven asset against times of turbulence. I said that for some traditional gold investors who used gold for that reason, those have moved to crypto. But that's not what crypto is all about. Crypto is not at all about that. Crypto is about the evolution of money. It's about getting out of the financial system. It's about the freedom of the economy. It's a humongous list of things that crypto is above a hedge for times of turbulence. So why? Let's then answer the second scale of the question. Why isn't crypto going up? If it's Well, it isn't going up because the same people that invest in crypto are the same people that invest in stocks and everything else that's going down right now. And they react with the same fear and greed as well. Now, if it was up to me, crypto prices would be going up. If I was the only investor and there was no one else, yeah, I wouldn't sell, I wouldn't care. But then if it was just me, stocks would be going up also. Because like now, for me, it's like the best time to buy stocks. Are they going to go down from now? Yeah, sure. But that doesn't mean that it's not a good time. It's a very good time. Every time you have a retracement is a good time. The stock market has been performing, going up for 100 years now. It's not going to stop. Like, okay. But the thing is that retail investors and even professional investors can take losses. They enter a position where they take a 20% loss, they get out of the position. That's how people have been behaving, and they're going to behave forever. So prices are going to be going down. There's going to be a time where this changes. I'm guessing my answer is not entirely super clear, but I've kind of explained why the situation is like that with crypto. But I do think that at some point, I don't know when, at some point crypto is going to be a safe haven against these kind of turbulent times, and someday cryptos are going to be going up when we have problems in the world instead of going down together with stock markets. I thought that this would happen now. I thought that this is the time now, but it seems that we're not mature yet for that. But we will be at some point. We'll see when, I don't know.
Okay, thank you very much. Now, I'm going to move things across to the FX world. So we've been speaking about the US dollar. It's clearly rallying. It's at 20-month highs, thanks to the Fed. What is your opinion on sterling, the euro, and of course the Australian dollar? Clearly we're in downtrends, but are we headed for further losses? Also, it would be great to get your opinion on the dollar yen. That's recently powered higher. So yes, especially given the latest that happened on Thursday, and where we could be headed in 2023. So I'll start with Lalit, please.
If you talk about the sterling, euro, and other currencies against the dollar, I mean, yes, there is, after the pandemic, all countries are into recession mode, and the US only who actually aggressively focus on to inflation and to interest rate hikes to manage the inflation. And other countries, even I have seen, the euro is also going to plan to rate high interest, so we can see some ways correction. But I believe, euro and sterling is still fall. It is not going to be rebound. We can see more fall. We can see more fall into sterling and euro in future.
Thank you very much, Lalit. And Gary, please.
Yeah, so yen spiked after reaching a record 24-year low. Central banks start buying the yen, which they haven't done since 1998. Now, the problem is the yen is going to continue going down because now the imports are getting more and more expensive, especially in energy and food. So it's going to penalize the economy. There is another notion that is not very known by the public, is what we call carry trades. A carry trade is when investors borrow at 0% interest rate a safe currency like the yen, and they are investing in a high-yielding currency, which is what tanked the yen in 1998. It's probably going to happen again because now the condition in the market is likely to favor that, because every other currencies are at a level of interest rates of 4 or 5% minimum. So that is going to plunge the yen even more, and it's going to have maybe the consequence of putting the economy to a global recession, which they've not seen it coming in the past 80 years. So that's my opinion. Yeah.
Thank you, Gary. And Alex, please.
Okay, so when it comes to US dollar, as long as they keep on raising interest rates, the dollar is going to stay strong or going to strengthen further. The reason is pretty simple. When the interest rates are high, it makes a lot of sense for an investor to invest in dollars because they're receiving a very good reward from borrowing dollars to someone else or to investing in dollars, or So you have a lot of inflow in the United States now because of those interest rates. When it comes to sterling, there is a lot of terror there that the economy is getting crashed, that things are not going very well, and fear is driving the sterling down. When it comes to Europe, things aren't going well here as well. Very high inflation, humongous energy problems with natural gas and oil, especially with natural gas now that the winter is coming. I mean, their answer so far is like renewable energy sources, which is a great answer for like 40 years down the road or something. But, winter is coming now and people are going to freeze. So they need to find a better solution. So they have a lot of stuff in their plates as well. You combine that with the dollar raising interest rates and the inflow of currency to the United States, and also dollar being a safe haven asset, and also people generally and institutions thinking of holding a lot of cash, and cash-backed securities because of high interest rates and the problems that are in the world. Unless the situation turns around, dollar is going to keep going strong. The rest of the currencies are going to be going down. When it comes to the Bank of to Japanese yen and what happened there, carry trading is a thing, and if it continues, and if it can happen like it happened back in the day, we can have the same thing with the yen crashing completely. So I'm covered with that answer. I don't have anything to add on the yen. So we need to see a structural change in the current economic environment in order to see the situation reversing. Will it happen? Yeah, it's going to happen, because even though they're raising interest rates, they don't want them high, they want them zero. So eventually they're going to go back to 2% or 1.5%. It's going to be in 2023, 24, probably 24, 25. But when this happens, dollar is going to start losing value again. If Europe has solved the problems, euro is going to start going up again. And with sterling and England, I don't know, they left the European Union. I don't know what's ahead of them. We'll see. So that's the situation.
Thank you very much, Alex. And finally, John.
Well, I think the panelists have covered. I'll recap. It comes down to, once again, containing inflation, the US hiking farther. My view is very simplistic. We're going to see a stronger dollar, therefore a weaker euro, weaker pound. I mean, everyone knows exiting the European Union was not necessarily a beneficial outcome.
Do you have any forecasts, any levels, any support levels you're looking at long term?
Well, sincerely speaking, I haven't done much TA in recent time. I'm no longer an active trader. But given the macro aspect of things and some of the reports we get from our PB, we have very nice research pieces, and I like to have a little bit of bedtime reading. And some of the forecasts that I see from Tier 1 banks is we're looking at close to parity. And this is within...
For the pound dollar.
Yes, indeed. So the pound seems to be under a lot of pressure. I mean, you can see it across the whole space. The euro, well, again, Europe is in an unfortunate period. I like to use a little bit of diplomacy here, but I think we all understand where they stand at the moment. There's a lot of debt. There's a lot of households in a situation where no one wants to be. And inflation, again, running at these levels is not going to make things easier. So stronger dollar, weaker, any basket currencies that you look at.
At the end of the day, for all the audience here, it matters for them to put two currencies together in perspective. Because we could be debating here, yen is going down, pound is going down, dollar is going down. Yeah, okay, but what is it for me if I was to invest in euro dollar? If they're both going down, which one goes down more than the other? So the answer, if I could give you one, I think we have to go back to the dollar, because it has always been the currency that rules the world. And I think for 2023, it won't change. Now, the problem here, there are some hidden stuff that nobody's telling you in the market. The first thing is there's going to be a bond crash. We will probably be facing the worst decline in the bond market since 1949. Interest rates are soaring, as you know. The US aggregate ETF, a bond ETF, has plummeted by 15% already. You're going to think, okay, but if the interest rates go up, why is the bond price going down? They are supposed to have the opposite correlation. The thing is, it has everything to do with the yield curve. The short-term yield is more expensive than the long-term yield. So that is why, with an increase of interest rate like now the central bank is doing, they are forcing the bond price to plummet. Now, bond price is what you're supposed to hedge the stocks with. So if you can't hedge the stocks, it's going to have a global negative impact on the stock market. So there are going to be further liquidations. All these crowded trades that those big companies, the big tech, have been holding are now going to liquidate those positions. So the long dollars, the long US techs, the long private equity are all going to close. And you know the saying, if people capitulate on those stocks, they are the favorite stocks, that is not looking good. That is not good at all. It's not a short-term trend. So if we are going towards that, obviously it's going to depreciate a lot the value of stocks, which is going to force the dollar to decrease at some point. So that from the point where the bond crash is going to be in effect. But it's going to come there because the central bank has forced the raise of interest rate too strongly. They should have tightened the monetary policy prior to the start of the inflation. They haven't done it. And now they are paying the consequence of pushing the interest rate too strong to limit the effect of inflation or try to bring the inflation down to 2%, but it's too late. They are going to have an impact on the people.
Behind the curve, right?
Exactly. And those people, unfortunately, they won't be able to consume, they won't be able to borrow money anymore. So what's left? They will have to sell off what they have, and the value of things are going to go down in time. And that's what we call a recession, if not more.
One thing I like to say is I don't want to be a central banker at this time of the year.
Oh, no, definitely not. Look, gentlemen, and to wrap things up, I really wanted your advice for any new traders or investors that are present. As we cross into 2023, what advice would you give to a new investor entering this current environment? So I'll start with John, please.
Well, one hell of a question. Stay out of risky assets for the time being, until we have some clarity, until the Fed contains inflation. Try your best to minimize your exposure, unless you have a very high tolerance for risk. Most people don't. That's just nature. Each one wants to feel secure at any given moment, especially throughout the cycle of any investment. This will be my strongest advice to anyone. Be cautious on what you're getting yourself into. At least try to understand the product that you're involving yourself in.
Thanks, John. Alex, please.
That's great advice from John. Actually, that's awesome advice. So, since you asked me this question, like what would you say to a new investor? I would not talk about assets or asset classes or where or whatever. I would kind of say pretty much something very similar to what John said. I would tell them that this time it's a very, very difficult time for the markets, even for professionals, for institutions, for brokerages, for everyone. So anybody who's thinking of entering those markets, they should be very well educated about mostly the psychology of trading. They should very clearly define the risk tolerance. That's the most important thing. They should know exactly why they're getting in, how much they can lose, what they're going to do if they lose. I think the current market is structured very well for a person that has inflows from somewhere except trading. So, for example, there is a technique called DCA. It's the best thing you can do, especially in markets like that. It means dollar cost average. What DCA means is that if I have $100 to invest, I will invest like $5 or $10 per month every month. You cannot lose with DCA. It's impossible because you buy lower, then you buy higher. You follow the market. It averages down, so you get the average part of the market. Whereas if you buy now, for example, if you put your whole amount and the market crashes 50% more, you're finished. So even if going with DCA, people should be. It will be very good if you have extra inflows from your salary or from anything else, or from your investments, or from other savings that you have, or I don't know how. But this market is very good for putting an amount. Then when it goes down, you use your other inflows and you cover and you cover and you cover and you cover, because at some point there's going to be a bottom. The thing is that it's a market. No one knows where the bottom is going to be. Even with stocks, if they can fall like 50% more, why not? They're stocks. They do whatever they want. But so there is no thinking like, where retail investors, when they get in, like how much more you can fall. It can fall up to zero, to nothing. So that's how much. So a good advice for a new investor, if they really want to go in, to recap, first of all, DCA, don't put all their money in. Second, read about trading psychology, understand the risk tolerance. And third, try to have inflows that don't come from just from investments. Because at this time when investments are hurting, you need to have something else in your life going well. When the stock markets, everything's going up, yeah, then you can be like, oh, I have my investments and everything's great. But now, no. Now you need something else to give you your main source of income and to cover your losses from investment. And investments, it's time to wait. It's time to be patient. So that's the answer.
Thank you, Alex. Lily, please.
See, the market is behaving is like uncertain. I mean, so what I advise, I mean, this time is like where the traders and the institutions and the professionals, the time is to choose the risk management strategy with short-term invest only. It's not a time to, you need to wait the longer term, and you need to wait to a high volatility market, and you need to wait to, to higher returns. I mean, the time is like where you can invest, and, it's time to exit as soon as possible. So time to trade the short-term investment, there's a huge volatility in the market. So time to enter and exit is just to be in a short term.
Thank you, Lily. And yeah,
I totally agree with you. I think volatility for most of you may seem like a great opportunity, but too much volatility will kill you. And right now we are about to face some of the turmoil in the market we've probably have never seen in our lifetime. So what I would suggest, if I could say humbly, is obviously to hold some physical, buy and hold. The gold, buy and hold the silver, probably more the silver than gold, to be honest, because you can buy more quantity, it's cheaper. But nothing online, just because, in those times, you have to be short-term on everything. You have to be short-term on your trades, you have to be short-term at keeping your money in one place as well. So I would say, and diversify. Don't put all your money into one bank. Don't put your money into one broker. If you can split it, it would be best. But and from a trading point of view, yeah, just lay low for a bit. You will see when the crash starts that there will be pretty much triggers. For example, that the monetary policy in the US is not able to tightening the economy too much, is not able to contain the start of the recession, and now they have to face inflation and recession at the same time. When this triggers, you're going to have a 1 year and a half to 2 years forward in front of you to simply short the things you already have, or to just short sell the market. Short selling is pretty much the view here, pretty much on every asset class, except the safe haven, yeah.
All right, thank you, guys. Look, I want to express thanks to the organizers of the event, WikiFX, and the sponsors of the event, and of course our highly knowledgeable panelists. Thank you very much, guys.
Thank you so much, guys. Thanks for attending.
Thank you so much.